Hey everybody, Tom Graff here, Chief Investment Officer at Facet. Today we're going to talk about recession risk. Perhaps nothing's more important to investors than whether the economy slips into recession or not. My take is that recession risk, not all that high. There's a lot of things going for the economy, and only a few things not going for it. So while maybe it makes sense to have some recession protection, I don't know that I'm ready to say a recession is all that likely. Now let's get into why. So when I say that recession risk isn't that high, let's get into that. I think there's kind of three things that are worth really worrying about. Last time I talked about the relatively weak level of hiring, so that's one. I've also had some somewhat concerning reports coming out of manufacturing where it looks like maybe manufacturing activity is contracting. And last we have commercial real estate, so certainly office buildings are really struggling, but kind of so is apartments. You're seeing a big decrease in apartment construction. All those things are a little bit worrisome. But I think there's way more things going for the economy than going against it. I'm going to go through some of the highlights right now. The first is one we talked about when we talked about jobs, and that's the lack of layoffs. Companies really aren't laying people off, and perhaps that's for fear of not being able to hire them again. Just before COVID, so during sort of late 2018 into 2019, then again just after COVID, sort of in 2021, 2022, there was a very tight labor market and companies weren't able to staff up as much as they wanted to. And it could be that companies are a little bit worried about this and don't want to lay people off. So we might be going through a period where in a different world, there might have been more layoffs right now, but right now there just aren't. The second is that the credit markets are very strong. So this means both the market for big companies to borrow in the bond market as well as bank lending. Usually at the beginning part of a recession, there's a big increase in the tightness of credit markets. It becomes harder to get a loan. Right now the opposite is happening. Banks are actually easing up a bit on their lending standards. And certainly in the bond market, in the private credit market, the loan market, all those parts of the kind of more large company lending areas, it's wide open. It's very relatively aggressive. We also have the fact that the Fed is probably cutting rates. It's likely to cut interest rates maybe 50 basis points, maybe 25 basis points. But we're definitely at the beginning of a cutting cycle. And that should reduce the amount of restraint on the economy. The Fed funds is at a range between 5.5% and 5.25% right now. And estimates of where neutral is, so the area where the Fed is neither sort of harming nor stimulating the economy, is somewhere in the threes probably. So there's certainly a lot of room for them to get less restrictive. And if they get less restrictive, it only stands to reason that recession risk goes down. There's a lot of pent-up demand for housing. So a lot of times housing activity is a big source of just general economic activity. When someone buys a house, they don't just buy the house. They also usually buy some furniture. They buy some new decor. They do some remodeling. There's a lot of things that go on related to a house. But housing activity has been extremely low. The resale market for housing is about as weak as it was in the middle of the Great Recession right now. But if interest rates drop a little bit, we know that there's a ton of people in that kind of prime home buying age of kind of in the mid to late 30s that have been waiting for a little bit more affordability to buy a house. And I think if interest rates drop a little bit, you could see a big surge in housing demand. The next one is consumer balance sheets. So if you remember in the last big recession, I'm sort of ignoring the COVID recession, but in the Great Recession in 2008 and 9, that was really caused by consumers borrowing too much. And then when the economy weakened, they had to greatly reduce spending in order to kind of make ends meet, right? So right now, consumer borrowing is actually quite low. The overall amount of debt relative to disposable income is much lower than it was during the 2010-2019 period. Today, the percent of people's income they're spending on debt service, so that means the monthly payments you're making to your mortgage or to your credit card or to your car or what have you, on average, those are also much lower than what they were in past cycles. So consumers really aren't up against it right now, which means they have headroom to keep spending even if there's somewhat of a downturn in other income growth. So lastly, we have what economists call the fiscal thrust, which is just a fancy word for the federal deficit. Right now, the federal deficit's about 6% of GDP, which is relatively high. It's only about 5 years since World War II where the deficit was that large as a percent of GDP. And so we can debate whether that's, politically what should be done about that. But the reality is that neither political candidate seems to be talking much about deficit reduction. And I think it's consensus amongst economists that no matter who's elected, we're going to continue to have a pretty strong fiscal thrust. And that's just another source of positive GDP growth that could help us avoid a recession. So, recession risk. It's not zero. It's worth having some protection against it. Let's remember that there's a lot going for this economy, only a few things that are kind of going against it. And to me, that means it's much more likely that we'll keep growing than that we'll slip into recession sometime in the next year or so. If you like this content, if you want to see more, we're going to be coming at you about every week. You can hit the subscribe button below. If you have comments, questions, if you have madly disagree with me, feel free to put a comment in the comments section. We'd love to hear from you, and we'd love to see you again.